Morning, everybody. Welcome to today's workshop. It's going to be small business financials, and this one is going to particularly focus on cash flow, which is extremely important. So next slide, please. So my name is Jerry Smith. I'm with SCORE. We're going to sort of be here and host the webinar and be available to monitor the chat and the Q&A window. As a reminder, just please keep your mics muted. And at the end of the presentation, sometime later today or maybe even tomorrow, I'll kick off a copy of the slide deck and also a recording of the workshop for you. You also see a questionnaire come about. I think that comes out tomorrow. So if you could and you had some time, we'd appreciate your feedback on the webinar in general. Next one, please. And just a little bit quick rundown about SCORE. We're a resource partner of the SBA, 100% volunteer-based. We have two primary areas of focus. The first is what we're mostly known for is a one-on-one mentoring. And we also have educational program, sort of what you're seeing here, workshops, online resources that are available, spreadsheets and articles and such. And bottom line message is we're just here to help small businesses in any way we can. The best way to find us is at the website, piedmont.score.org. From there, you can see other workshops, and also you'll see a link to request a mentor. And at this time, I'll introduce our presenter, Earl Gregorich. And Earl is with the South Carolina SBDC as the Greenville area manager. And you can see, I'm not going to read all the details, but you can see Earl's extensive bio over on the right there, background spanning back into, looks like the early 1980s, focus on small business and strong military and veteran background. So Earl's going to talk to us this morning about cash flow. And yeah, interesting to hear the presentation. And at this point, I'll turn it over to Earl.
Right. Thanks, Jerry. I appreciate that. And thank you for not reading all of that bio. That's quite the stuff there. So just a little piece on SBDC before we jump into our content for today. For those of you who may not be familiar with who we are, what we do, South Carolina Small Business Development Centers, we have 21 offices here in South Carolina. We're actually part of a larger organization, a network of 1,000 offices across the United States. And our mission basically is to help you advance your small business, grow that business here in South Carolina. You also note that we are part of a consortium of higher academia, and each of our offices are sponsored by one of the four that you see at the bottom there: University of South Carolina, SC State, Winthrop University, and in my case, Clemson University. So we very much appreciate them allowing resources to us so that we can accomplish the mission at hand. Some of the things that we do, you're experiencing one of them here: education, programming that we do all the time in various different shapes and sizes, 1 hour lunch and learns like today, all the way up to multi-session series that we do. And we cover basically all facets of small business. So if it's, you're in very early stage, just kind of kicking around an idea, not sure how to get your head wrapped around that, we do that. If you're in early stage and you've got the wheels turning, but it's kind of a rough ride right now, that's okay. We can help you smooth that out. And then, of course, if you're in growth stage or maybe even in exit strategy stage, we can help with that as well. So SCORE and SBDC, we're kind of your best first phone call. We don't cost you anything. We're very well connected. And you're going to be talking with people who've done entrepreneurship, been in the trenches, paid the taxes, had to make payroll, tried to figure all this cash flow stuff out. We've all done that before. So we're here to help make that a little bit smoother for you. You'll get my contact information towards the end of today's presentation, and you can reach out to me directly if you're interested in setting up a time. So let's get started on today's topic, focusing on cash flow. So we're going to do this kind of in a real world application setting and introduce you to our fictitious entrepreneur. Hopefully I don't see any Chris or Christinas here in the room, so nobody can accuse me of singling them out. But Chris is a 36-year-old entrepreneur. She's running a consulting service called Apex Services. She's only has one employee. She's thinking about maybe adding another, but not quite sure if she can afford to do so and still pay herself. So we're going to be looking at some of the financial aspects of that, because in her case, she doesn't really have a bookkeeping or an accounting system set up quite yet. And obviously needing to hire that additional part-time or contractor, she's going to have to get a better handle on her financials. So cash flow is going to be a major concern. So some of the things that we encourage folks when they're jumping into making some bigger decisions on their business, whether you're in startup, growth, or exit, you want to surround yourself with good data. You want to have good numbers that you can base your decisions on. So, how do you do that? There's so much going on in the business. There's paperwork going left and right. There's all kinds of requirements depending on if you have employees or not. There's all kinds of stuff floating around out there that you have to keep track of. And somehow you got to boil that all down to where these numbers make sense. So you see here, we've kind of outlined some things that you can do. This is not a comprehensive list, but this certainly will get you on the right track. Maintaining at least 3 months of your billing and bank statements in an organized fashion in a place that you can get your hands on. That's a good thing to do. Having your client, vendor, supplier lists readily available so you can start filtering those and figuring out where you're getting the most bang for your buck. That's a good thing. Of course, financial statements, cash flow, accounts receivable, accounts payable reports, income statements, balance sheets, these types of things are crucial to making decisions. And that's where we'll spend most of our time today. And then tax returns, you want to always keep your tax returns up to date and handy, and make sure that you are also checking your credit on a regular basis, both personal credit and business credit. And if you have questions about business credit, that's kind of another class, but I may be able to take some of those towards the end today. We can talk a little bit about that as well. And then any kind of documentation for benefits, or if you do have employees, you want to keep good records, good paper records and digital records on those aspects of the business as well. So today we're going to focus, like I said, more so on the cash flow and the financial statements, but that's a really good to-do list to get you started so you can be organized and pull off some of the things we're going to talk about today. So as I said, how do you pull this all together? Maybe your desk looks something like that first picture there with the help sign. You got all this paperwork stacked up. How do I organize this? Well, first and foremost, you got to sift out what's important, what's not. I encourage you really to kind of set up, for lack of better terms, a notebook, a binder, whether this is digitally or actual paper, depends on what you're working with. But I would also encourage you to really consider having an actual paper notebook. I know that sounds kind of old-fashioned, but hey, things happen, computers crash, cyber attacks happen. Sometimes we have a natural disaster. It's always good to have something to fall back on. And as we saw in the pandemic, a lot of small businesses could not produce the proper paperwork to apply for aid or some of the loan packages that were available out there. So having paper is not necessarily always a bad thing. It might be a good practice to have that set up as a backup and maintain those statements and the like. So if you can get it into a notebook or some organized fashion, then chances are you can also convert that to a digital process. And that's what we're going to talk about today, is the digital side of this. But make sure as you're putting this together, whether it's paper, digital, whatever, think about who you might have to be presenting this information to. Again, is it daily operations? I've got to talk to my accountant. Is it a situation where I'm stepping forward, I need to ask the bank for a loan? Is it a situation where I'm going to be approaching investors? Maybe a pitch deck is going to be required, and I got to back that up with this information. Or is this a disaster situation? I've got to pull this together so I can help my business in recovery mode. So think about those different aspects with which you would need that information, and organize it so that you would be prepared for each of those, or at least the most likely circumstances. So when we got this stuff in front of us, it makes us better decision makers with our business. Numbers are important because, frankly, I think we all would agree if the numbers don't work, the rest of it doesn't matter. You got to be able to pay yourself, got to be able to keep the lights on. So without really good financial information, it makes it very difficult to make wise decisions, whether that's daily operations or whatever. Having a good accounting backing is great. We do encourage that you work with an accountant probably within 6 months of opening a business. They don't have to cost very much. I have a lot of small businesses that they only touch base with their accountant maybe twice a year, and then once they get to sit down once a year during tax season. That's typically not a very expensive arrangement. And in my personal experience, I've been a business owner 4 times over. I've never spent money on an accountant that I didn't get back and then some. They've always saved me more money than I've spent on them. So I highly recommend working with an accountant. Chances are you or the owner are going to be the bookkeeper, but you can hire that out as well if you choose to. But bookkeeping and accounting, not the same thing. Accounting is where someone is doing more strategic work. They're doing more analysis on your numbers. They're giving you steps to improve your situation. Bookkeeping is basically just organizing the financials, the data, the paperwork that's coming and going, making sure the invoices get out, those kinds of things. That's the bookkeeping side. And usually that falls on the shoulder of the owner or someone within the business. If you're looking for assistance in pulling this together, we're going to be using Excel for the most part today. And the numbers that we're going to be pulling into that spreadsheet, most likely for most small businesses, would come from, say, QuickBooks. Xero is another big one that's out there. And there's several other platforms that are available to small business. But QuickBooks is by far the most popular one out there. It's one that you can rest assured that if you go talk to an accountant or a bookkeeper, they're going to know how to use QuickBooks and how to interact with your business if you're running that. If they're not, then you might not have the right accountant or bookkeeper, because you just about have to know this in order to be in that business. There is still a minimal debate on whether you use QuickBooks Online or QuickBooks Desktop. There is a desktop version of QuickBooks, and then there is a cloud-based version of QuickBooks. All the businesses I work with these days are all on the QuickBooks Online. That comes with a monthly subscription format, where QuickBooks Desktop is usually just a one-time purchase. You might think that the desktop sounds like it's a better deal since you only have to pay for it once and you can use it for an extended period of time. But what you'll find is about the time you'd be up to what you would be spending on a month-to-month subscription, you probably have to update or upgrade your desktop version as well. So you're really not a ton of money ahead by going desktop. So still is. Yes.
I'd make a comment on that. I also, with the online version, there's a lot of flexibility. If you just happen to be, let's say you're out on vacation or something, and you check in, as long as you have, sort of a secure connection and a secure window, you can log into your QuickBooks Online from another computer. Also, there's a lot of other operating system notebooks out there now, like Chromebooks and stuff like that, where you would have a specific Windows software for the desktop. So there's some flexibility with that online. So just wanted to make that comment.
Absolutely. It is much, much better at integrating with other systems, connecting your bank, all of those things just run so much smoother on the online version than the desktop ever did. So if you need assistance with that, if you're on the fence as to which which version makes sense, just reach out. I'll be happy to run you through some of the possibilities and some of the gotchas that you need to look out for on either one of those platforms. All right. So some of the things that we keep track of when we're doing the bookkeeping / accounting, obviously, these are some of the high level numbers that most small business owners focus in on. Sales, we can track our sales, and not only just the fact that we have them and how many or how much we're earning in sales, but we can also kind of drill down and figure out, well, what is selling, what's not, what am I making more profit on, what am I not? Those are valuable questions. Making this switch to being able to be proactive about the numbers, not reactive based on the numbers, is a huge deal for a lot of businesses. Having one big pot that you dump all sales into, so you can say, yeah, I made $200,000 in revenues last year. That's one thing, but being able to tell me exactly what products were the lion's share of that 200,000 and which products of those actually earned you the most profit, that's the make or break between a business that survives and a business that thrives. So sales is something that we track. Expenses, obviously, we cannot improve profitability if we're not tracking what we're spending our money on and trying to improve upon that day in and day out. So tracking expenses, converting all of the activity that we have in the business to that bottom line profit is also something that we need to be able to do. And it's surprising the number of small businesses that cannot, with a great degree of credibility, tell me what their profit margin is in the business. They think they're making money, they hope they're making money, but if I ask them how much money are they making, a lot of them can't tell me. So tracking profitability in the business and setting this up such that you can improve that profitability, that's really kind of the goal here. Knowing what the business owns and what the business owes, a lot of times there's an assumption that the business owns something. I use the car for business, therefore the business must own it. But the fact of the matter is, if it's not properly put onto the books, then the business doesn't own it. It's not an asset of the business. And we find those issues from time to time. What the business owes, those bills that need to be paid, you don't have to wait too long for somebody to tell you that you owe them money. So it's you don't necessarily have to have accounting systems to know who you owe money, but it is good if you want to be proactive and plan your way through the payback of, say, a loan, or even planning out, how much money you're going to need for utilities, say when summer hits and the AC goes through the ceiling. Those are things that you need to be proactive again and plan out, and that's why we're focusing on cash flow today. And then it'd be nice to know that whatever all this effort you're putting into this and all the money you're putting into it, what's my return on that investment? What's this business worth? If we're not tracking financials, if we're not producing reliable financial reports like profit and loss statements and balance sheets and the like, we can't really give a really good firm answer on what this business is worth. So that's extremely important too. And then cash flow. That's certainly one of the things that we're keeping track of and what we're going to delve into here in just a second. So if you've been in my office or a store office anytime in your business life, whether short or long, you have probably been introduced to this spreadsheet that I'm about to open up and show you. We're going to demo just the cash flow aspect of the spreadsheet and tell you how it works, show you how you can work with it such that you can do some proactive planning on the business. As we said, Chris here is trying to figure out if she can pay herself and still bring on another employee. So we're using the spreadsheet in its projection format so that she can look into the future and make those kinds of decisions. So let me switch over to that spreadsheet. All right, so everybody should see the spreadsheet now. Thank you, Jerry. And as I said, if you've worked with us before, you have probably seen this, and that's great. It'd be wonderful if everybody walked in and said, yep, already seen it. I'm very familiar with it. But if not, that's not a big deal. We can certainly coach you through the process of using this. So let me just get myself situated here so I can navigate. All right, here we go. So again, you can see this spreadsheet here, and this is downloadable for free off of the SBDC website as well as the SCORE website. In fact, we can probably include this with the mail out when we send out the slides and all of that. You probably will be able to get that. If nothing more, less, we will make sure you have a link to it. But this is can be intimidating to those of you who may be a little fearful of Excel. Don't worry about that. We can certainly get you beyond that. We can also let you know that when you come in here, you really only have to worry about the first 5 or 6 tabs when you're putting information into it. It's about 12 tabs long, but you really only have to fill in like the first 5 or so, and you only have to worry about these orange and yellow boxes. You don't have to worry about filling in all the rest of this stuff. It'll do it itself. So again, I'm not going to give you a course on how to use this spreadsheet per se. I just want to show you how you can use the cash flow portion of it. But in order to do that, I need to show you some of the things that are going to impact that. As we know, many things impact cash flow. And one of those first things is how much cash do I actually have to manage? So in this case, in this example, Chris has $10,000 of working capital in the bank. She's working with a loan that she currently has that has a monthly payment of $438. So that's a negative impact of cash flow. And she has to be able to maintain that, right? So she also has payroll, and payroll is made up currently right now of a full-time and part-time employee mix. That would be herself and a part-timer that she has on staff. So she's running a payroll on an annual basis of about $42,000 to $43,000. Again, this is a projection. This is her current year that we're living, and then these 2 years would be the projection pushing out into the future. Other things that impact cash flow would be the amount of sales that are coming in. So you're loading up the sales here. We're itemizing what she is actually selling. So in her case, it's a consulting firm, and she's selling consulting services by the hour. So in her case, $80 per hour. Those consulting services do not have any cost of goods because it's all speaking intellectual property. There's no hard goods associated with the delivery of that. She has some books and downloads and things, and there's a little bit of cost of goods associated with that, by the printing of the books, printed materials, and postage. Maybe she dumps into that, I don't know. But and then speaking gigs. So she gets $800 for a 4-hour session on a speaking gig, and that's basically what she's bringing in revenues as a per unit basis. Now the spreadsheet works such that we just say how many of each of these items she's selling or plans to sell each month, and that gives us then total sales on an annual and a monthly basis for each of these items. So when we get to the and we see that money coming in, it's coming in from this section where it's generated by the products that she's selling and and the number, the volume that she says she's going to be selling. The spreadsheet will automatically do, like I said, years 2 and 3 are automatically put into this model with a 6% year-over-year increase. That's her expectations as to the growth pace of her business. That certainly can be changed, but in this example, we're using 6%. Another thing that can impact cash flow that small businesses need to be able to track is how quickly are they collecting cash from their customers, and is there any loss in the collection of the money from the customers? So in this particular example, Chris is saying that she is collecting 75% of the invoices that she's billing, or 75% of the billings. She is collecting that at 75% within 30 days of being billed. 20% end up taking longer, somewhere between 30 and 60 days to pay her. And then 4%, they lag behind their slow payers, extremely slow payers. 4% of her invoices are paid at that pace. And then she does have about a 1% loss for bad debt. That means that's the amount that she could not collect. So your business may or may not have this model. If you're a cash-based business, you don't have accounts receivable. You're not sending invoices and waiting for money to come back in. So therefore, 100% of your business would be paid within 30 days. Some of you may work on a 50% upfront and 50% in completion, and that completion might take 6 months. I don't know, but you would have to set this model up such that it reflects your business. The reason this is important is when it comes to cash flow, when you do the work at the beginning and then you have to wait for the cash to arrive, there's a gap, and you have to be able to survive that gap. That's what cash flow is all about. Do I have enough cash to float myself between the peaks and the valleys when I'm running my business? So knowing to some degree of certainty how much of this cash you're bringing in and how long it takes to get it is extremely important, because now you can define what those peaks and valleys are and how wide that chasm is. If you don't know, if you're not tracking this, then you're basically taking a chance. You're just taking a shot in the dark that you've got enough cash in the bank to get you from now until the next time the invoices get paid. So tracking that is extremely important. So we also have to put in those expenses that we talked about. So we have to money out of our model. We talked about the revenue, the sales coming in. That's the money into the model. This is the money out of the model. So we've got your typical business expenses in here, everything from advertising to utilities and taxes, and all these good things get wrapped up into this section here. And we have this shown on an annual basis. You can see here that for operating expenses, Chris is running somewhere between $40,000 and $42,000 in annual expenses for her business. We also have other things like depreciation and the loan that we were discussing and so on that also can impact cash flow. And that all gets calculated into this spreadsheet so that we can get a really good idea of what cash is coming and going. So up to this point, we've done inputs on money in, money out, basically. So what does this look like on a month-to-month basis? That's where this all becomes a much clearer picture. So here we have the first 12 months of Chris's business displaying just cash flow, describing money in, money out in a month-to-month fashion. So how do we read this? You remember on our very first slide, I showed you the starting working capital of $10,000. So right here is the very beginning. This is January. Very beginning of the year, she started with $10,000 in the bank. And then from that, or to that 10,000, we add the inbound sales. Okay, so the cash sales that came in for the month of January, just shy of $9,000. So then we move down and we take out of the equation the expenses side of things, the loan payments, the operating expenses, the payroll, and so on. That's the money out of this equation. So then we total these up. So you notice we had 10,000 when we started. We added $8,800 to that. Our total outflows are $10,000. So notice we spent more than we brought in. So we're at a negative $1,327. That's what we would refer to as a negative cash flow month. So we spent more money than we made. So that what that does is it takes our cash down, because we started with 10. In order to make up the difference of that negative 1,300, we had to take it out of our bank account. So what's left in our bank account now is less than what we started with, $8,673. So if Chris were to continue a whole year of Januaries and never get any better than that, she would be depleting her cash by $1,300 every single month. And obviously, in that case, she'd run out of cash by the end of the year, before the end of the year. So we don't want to do that on a regular basis. So at the end of January, she ends up with $8,600 in the bank. That $8,600 comes up to the top of February as the beginning cash. Again, we add to it the revenues that she made. Now notice, we have very similar, in fact, exactly the same amount of cash sales in January and February. However, we've got an accounts receivable amount that's coming into the picture here. This accounts receivable is coming into the picture because, remember, Chris didn't collect all 100% of her money within 30 days. I don't remember the percentage. I think it was 20%. 20% of the money took longer than 30 days. So the spreadsheet is saying, oh, okay, well, then 20% of what should have arrived in January, we're going to move over to February, and we're going to collect it in February. So again, we're getting a much more realistic picture of what actual cash is coming and going from the business. So this is the additional percentage that should have come in January but did not. We're adding that into February's numbers as additional revenues. So we had a $11,000 month in revenues. Our outgoing expenses repeat. So total cash outflows, $9,649, and total cash taken in, or inflows, $11,163. So in this month, we brought in more cash than we spent. So that gives us a positive amount going into the bank account. So like last month we were short, so we had to spend money out of our bank account to make ends meet. This month, we actually made some money. So $1,500 additional dollars went back into the bank account. So that left us with $10,187. So now we are $187 more to the good from where we started. And we just continue that cycle. And we go month to month. The month prior goes to the next month. We go through this exercise again and again and again throughout the month. So if we look across these lines here, we can take a note of how cash flow is working for us. So the net cash flows, you notice we still have some months here that are negative. All these ones that are in parentheses are negative, meaning we did not make as much as we actually spent. And we can then total that out at the end of the year and say, well, how much to the good were we month over month as on an annual basis? And you can see here that Chris is about to experience a year in which she only cleared almost $2,300 to the good. All right. So this line right here is important to keep an eye on. How many months am I having negative and how many months am I having positive? How do I change that? Obviously, if we could see all those to be positive, that'd be a great picture. That's what we would love to see. And you can get there. But in startup phase, we do expect some back and forth on that. Another line to watch is this line of credit drawdown. If you see a number there, that means the spreadsheet ran out of cash completely. There was no money, there was not enough money in the bank account to cover that particular month's expenses. That means that money had to come from somewhere else. The spreadsheet assumes you have a line of credit to pull from. That line of credit usually is your wallet, your savings account, your retirement fund, whatever it is that you go to in emergencies. That's where that money comes from. So if you see a number there, that means you ran out of cash. And if you don't have the money to put into the mix to make that meet zero, you could technically you would be out of business at that point. Jerry, did you have a comment?
Yeah, I just wanted to make a general comment on this particular slide, but everything that's sort of bubbled up into this to really distinguish for all the attendees that the key difference here between what Earl's describing and what you might get out of QuickBooks or your talk with your accountant. Often they'll look at what we call the income statement or the profit and loss statement. They're the same thing. And what that shows is it just shows the sales less the expenses. And you might just think, like, well, what's the difference? Why is what is what Earl doing here different than the sales less the expenses? And it is succinctly different because of certain variables, like he described, the cash flow that's associated when you're selling and you're selling on terms. So that first month where we had 20% of the sales that we didn't actually get the cash received for, we actually booked the sale for it. So it looks like it's revenue, but that cash isn't available until the following month. The same thing if we are going to be drawing on a line of credit or a credit card or something, that becomes cash that's available. And then later on, those payments back to the loan are cash that's removed. So this is a very, very powerful tool. And in cash flow, as Earl has been describing, it really is the lifeblood of the organization. So there are situations where you can look at your income statement and it may look like you're profitable, but from a cash point of view, you're actually losing cash. And there's such things as companies that actually go out of business to have a profitable P&L. Just wanted to reinforce that. I think that Earl will be touching on these as he traverses through the rest of the presentation, but I just wanted to make that comment here.
Yeah, and Jerry, that's a really good point to make. Small businesses assume, but two ways they assume that they're successful. One, profit and loss says they have a positive, profitable position. That means the bottom line says that it's positive percent. That does not necessarily mean you're 100% healthy, that you got everything going on and you're going to make it through without any problems. You can be profitable and have lousy cash flow. You can also have great cash flow and not be profitable. So you have to look at the big picture. You have to take into account all of these different facets of business. I tell people when they ask me, well, what's the difference between this and the P&L? Because you can look at this and you can see a lot of the same things listed here, revenues and expenses and so on. You can see all that stuff in here, and you can look at your P&L and say, well, it's all there. So what's the difference? The one thing that I throw in there, I said the biggest difference and the most important difference is this: it's your cash balance. It's the amount of money you have in the bank. That is not on your P&L. And until you sync this up with what your bank statement actually says, it's not as useful. So at the end of every month, so see at the end of January, let's say for Chris, she would get her January statement, her January bank statement. She would look at the beginning balance on that bank statement, and it should say $10,000. At the end of that statement, the ending balance for the month of January, it should say $8,673. If it does not, this is a really piece here. If it does not match, that means that somewhere in the accounting process, Chris has not accounted for some amount of money, whether that's inbound or outbound. So it could just be that it's just an accounting issue. We're missing some transactions somewhere somehow that's not hitting the books, or worse, it could be leakage, as we refer to it, meaning she's got information here. All this stuff is being accounted for, but what's hitting the books is not the actual amounts that's coming and going. So this is a really good exercise. If you're sitting there thinking, I've got a business going, I've got QuickBooks and yeah, I've got all this. But if you haven't gotten down to the point where you can take a cash flow statement and match it up to your bank statement and it matches, now you still have issues. Just because you have numbers in QuickBooks doesn't mean you have correct numbers in QuickBooks. And this is a really good way for you to test this. And it's also a really good way if you're sitting there at the end of every month thinking, you know what, I worked really hard. I know I had a bunch of invoices come in. Some people paid some bills. But where did it all go? I still don't have anything in my checkbook. This is a really good exercise to run against the business, because now you can search for those things like leakage. You can search for those things like accounting shortfalls. And this is really one of the easiest and quickest ways to catch those things. Somebody is asking about the spreadsheet. We will be sending out a link or the spreadsheet itself after class. As far as opening it, there are instructions on the first tab of the spreadsheet under directions that will explain how to open it up if you need to. But full disclosure, if you open it up and mess up a formula, it will be a mess, and it will take some time to fix it. So just be aware. All right. So this is a year. This is a year of 1 year's example of cash flow. I want you to note here that owner's distribution, this is what Chris is paying herself. So she wants to, in addition to payroll, at some point add to her pay another $3,000 a month in a distribution. So remember, on payroll, I pointed out that she had a full-time and a part-time in there. We can assume that the full-time was her and the part-time was the employee, because it said it was just her and one employee right now. So she is thinking about adding an additional $3,000 of income to her paycheck, and that's going to hit sometime in July. So we look at her cash flow, we see, well, how did that impact her cash flow? And we noticed that, you know, up to that point, she had accumulated an additional $7,000 in cash from the start of the year. She added another $17,000 to her account. So now she adds $3,000 to the equation. Notice that these negatives start creeping in here a little bit more than what they had in the first few months. Notice that first month she was negative, but after that she was adding to every single month. As soon as she added $3,000 for herself to the equation, she started having negative cash flow months on a consistent basis. Well, if her sales remain the same and she continues this path into year 2 and 3, chances are she will put herself in a position where she will run out of cash. So we can actually see that if we come over here to this year, we can see that if she continues paying herself $3,000 a year, those negative cash flow months continue. Her entire year went to a negative $3,400, so she lost $3,400 over the course of the year and in this model. So she took the $12,000 that she had left in the bank from year 1. Notice year 1 ended at $12,278. So year 2 starts at $12,278. With this model in place, she lost $3,400, so she ended year 2 with only $4,400 in the bank because she had a string of negative cash flow months. If we continue that, still $3,000 every single month coming out, still having consistent negative cash flow, not that much, notice, it's sneaking up on her basically. She started with the $4,400 in the bank. She ended with $1,400 in the bank. You can see this is trending in the wrong direction. She will quickly be in a position where she will run out of cash and have to feed this business money in order to continue this model. Of course, if she chose, she could decide, well, you know, it looks like that's going to put me somewhere $1,000, $1,500 to the negative. So she could choose to change this amount. I'm not going to pay myself $3,000 a month. Let's start out at $1,500. And let's just do that. Notice now we have ended the year in the positive, and we have eliminated, for the most part, those negative cash flow months. That still does not eliminate the issue going into year 2 and 3. She's still going to end up eventually running out of cash at 3,000. So she would want to make adjustments in these months as well, until the business gets to the point where it's generating enough cash to add that $3,000 payment. Now, of course, there are other ways to improve the cash flow. And the beauty of this spreadsheet you're seeing it happen here is I can go in and I can do what if scenarios. I said, what if I don't pay myself $3,000 a month and I pay myself $1,500 a month? What does that look like? Yeah, I don't get the pay that I wanted, but I don't have to start feeding the business money at some point. So if I changed all these, to 1,500, now I'm seeing quite an influx in cash. I went from 21,000 at the beginning of the year to having 31,000 at the ending of year 2. And that puts me in a much better cash position. But you can see that $3,000 amount is what really wreaks havoc on the model. As soon as we start paying ourselves to that amount, that degree, that's when we start seeing that negative trend again. So somewhere between 1,500 and 3,000 is the magic number that would allow Chris to pay herself an additional amount of money and still remain on that positive cash flow side. Now, of course, Chris could also work on other aspects of the model. If she were to find a way to increase revenues, whether that's in volume or possibly raising prices, to where she's bringing in more cash sales, then she may be able to afford $3,000 a month. Or if somehow she could come up with a combination of things that could help her reduce expenses, whether that's payroll for the part-time, payroll for herself, or operating expenses, if she could reduce those expenses, then she would be in a position to be able to, again, add up to that $3,000 amount, possibly, and still maintain cash flow positive position. Chris's original question was, can I bring on a part-timer and still afford to pay myself? The answer, as you probably can see here, is under the $3,000 addition of pay to Chris, she's not going to be able to afford to pay herself, let alone a part-timer, an additional part-timer to the business. In order for her to afford a part-timer, she basically is going to have to eliminate this completely and put that money towards additional payroll to pay that part-timer. So again, small business owners, we tend to make these decisions by just kind of looking at our bank account and thinking through some of the revenues that might be coming in and think, you know what, I think I can do that. Yeah, let's try it, Well, in this case, we're talking about personnel. And you might be able to say, yeah, I think I can go ahead and buy $5,000 more worth of inventory. And if you find out you can't afford it, you might be able to survive that. And it's not that big of a deal from the standpoint of, people. But if you hire somebody thinking you can do it without any preliminary work through the numbers, and then you find out you can't, well, you've given somebody employment that they've now counted upon. You've increased your stress level trying to meet that payroll. And if you'd have just done the numbers in the beginning, you would have seen that it's probably not likely that I can do that quite yet. And you would have saved yourself all that heartache. So that's one of the reasons why we suggest that you keep these numbers handy and run these on a regular basis such that you can make these decisions in a much wiser and less stressful atmosphere. So I'll return that back to the 3,000. I think, no, I had these changed here too, so change that. All right, so that puts Chris back to where it was when we started. So I just want to also point out, as Jerry had pointed out, eventually this all translates into income statements and balance sheets and those things that maybe you're a little bit more used to. This spreadsheet will produce those as well. So with that cash flow situation as it stands, you can see here that Chris's revenues coming in. There's, remember the sales that we showed that she was bringing in by unit. There's the amounts that she is by item, the amounts that she's bringing in each year. The cost of goods subtracted from that. And that gives us our gross margin here. So this is what she's making before she pays all of her operating expenses. And then if you remember, she had somewhere between $40,000 and $42,000 worth of operating expenses per year. So we take that 40,000 from the 17, and that leaves us with about 34,000 to pay other things like depreciation and all that stuff come into play down here at the bottom. So in her case, she's profiting 14, 16, 19% profiting. But as we saw, her cash flow situation is not great. It's trending in the wrong direction, even though she's got a profitable model here. So that brings to light exactly what Jerry was pointing out. So the P&Ls get created, the balance sheet gets created. This goes back to what I said earlier, what the business owns. The assets in the business, what the business owes in liabilities and the like, that's down here. And then as far as business valuation and some of the items that you would want to look at to see how healthy the business is at this time, that's listed down here in the equity section. But again, this doesn't look like a horrible picture, but from a cash flow standpoint, this business is not doing well. So cash flow has an impact on all of this, and this spreadsheet will produce the overall reports needed to analyze the picture, the business from a bigger picture. But cash flow, it will allow you to zero in on that specifically. The last thing I'll point out on the spreadsheet is it will also create a break-even calculation on year one of the business. So in this particular case, it tells Chris just how much in sales on an annual basis and on a monthly basis she has to sell in consulting services in order to break even, meaning she doesn't make any money, she doesn't lose any money. She has to, on an annual basis, sell just about $115,000 worth of consulting, and that comes down to about $9,500 a month in sales revenues. So I call that number right there, that is the keep you up at night number, because that's what you have to do every single month to make this work. So I'll stop sharing the spreadsheet and we'll go back to the slide deck real quick, just a couple more slides. We are. We good to go on that, Jerry?
We're good, Earl. I can see the spreadsheet, the presentation. Yep.
All right, good. All right, so just to recover real quick, the primary reports that we're working with here, and especially in this presentation, we focused on cash flow, what comes in and out monthly, what kind of cash balances you are carrying in the business month to month, how you can use this for both short-term and long-term planning, and then how you can actually assess what impact each transaction might have on the business. And in the case of Chris, adding an employee or paying myself a particular amount. And then that last bullet there, I like it, as I say, this is the closest thing you get to a crystal ball for your business. If you could sit down and look at the next 18 to 36 months in your business and tell with some degree of certainty that this is what's going to happen if I maintain this course, that would be a very empowering tool. And that's what this is meant to do. It takes you out of reaction mode, puts you in proactive decision-making mode, so you can now build that business with a little bit more confidence. And then, of course, I pointed out that this spreadsheet will do income statement, balance sheet, and break even, giving you some of the items that you see in the bullets there. So it's just a really powerful tool to use. So if you have all this stuff in place, what's some things that make sense for you to do? Reconcile every single month. I know that's an ugly word. Reconcile is a 4-letter word, right? But you have to do it. You have to make sure that those bank statements match the cash flow amount, and track it down if it doesn't. If you're running QuickBooks Online, you're very familiar with this because you're matching up the transactions from the bank as they come in, hopefully, and getting that taken care of. Make sure you're working with an accountant. If things get too far out of whack, you can always call up the accountant and say, hey, look, I'm trying, I'm getting it in there, but for some reason I'm not getting the right answers out of this. Can you help me? And sometimes you can reach out to SBDC or SCORE, and we can give you some pointers on what might be leading you astray if you don't necessarily want to contact the accountant and get the meter running. You might call us first and see what we can help you with. Start using these in your decision making. Don't sit down at your desk and just wing it. We're, as entrepreneurs, we're famous for that, but your gut may be really good, but your numbers are a whole lot better, trust me. Update your printed materials on a regular basis. Make sure that literally think about this. If the sirens went off, the tornado was 2 miles away and you had to get out of here, what would you grab? That notebook should be on the list as you're heading out the door. It should be, or be kept in a safe place anyway. And then eventually, if you're not using anything at all, ultimately we want you to be on some form of accounting system like QuickBooks or Xero or something like that. This spreadsheet is great. It's wonderful for planning. I use this. I have QuickBooks, but I also use this spreadsheet as a planning tool in conjunction. So we want you to graduate eventually to an accounting system. And then all this data that you have, whether it's online, it's in a spreadsheet, it's in a book, just make sure you're securing that. You obviously don't want this kind of information falling into the wrong hands, so protect that if at all possible. So with that, Jerry, I'll pass it back to you. I don't know if we have time for any questions or not, but I think we got in under the wire.
We did. We got a couple minutes left, and yeah, we actually do have a couple minutes for any questions, guys. If you have anything, throw it in either the Q&A or the chat window. As you can see on the slide that Earl has here, contact information for both of us. A couple of questions that you guys have had throughout the webinar have just been follow-ups in terms of the slide deck, the recording, the spreadsheet. Yep, absolutely. We're going to get all that out to you guys in the next couple of days. So just give me a little time to pull that together and send that off. Earl covered a lot of ground today. Very, very important topic. And at first glance, it can look a little complicated, but it's like most things. You sort of chunk it, break it down step by step, just the way he did in the presentation. Go through it as you're watching the recording. You'll have the spreadsheet. You can go through it yourselves. That what if scenarios that he was doing. You also see in the spreadsheet that it's the orange boxes that are the ones that you're able to modify and fill. So try not to change anything that's not orange. Those are the formula cells, and there's been a lot of time and effort and detail that's gone into to verify that the spreadsheet does actually calculate everything correctly. Those that are that really want to dive in and see how every formula is calculated, feel free. It's all there. But just have some faith that it is calculating it correctly. That way you can actually focus on the business aspects of the tool versus trying to determine how does it work from an analytical point of view. So, I mean, with that, I just want to thank Earl for his time. And, this was just an awesome tutorial on cash flow. And thank all the attendees for coming out today. And again, we'll leave it open for just another few seconds if you guys have any questions. Okay, well, everybody have a great afternoon, and thanks again.
All right. Thanks, everybody.